Disclaimer. Is greater than. On December 19, 2025, the U.S. Treasury released figures that most people overlooked. China's holdings of U.S. Treasuries dropped to $688.7 billion, the lowest level seen since 2008. CNBC mentioned it briefly. Bloomberg described it as routine portfolio rebalancing. But here's what wasn't explained. This is the same action that brought down the British Empire. In September 1931, France made a simple request to Britain: convert our pounds into gold. 8 weeks later, the pound sterling, the world's reserve currency for 200 years, collapsed. Britain abandoned the gold standard, and the empire entered its final decline. I'm going to show you why China's $628 billion sell-off is not just a transaction. It's a statement, and the countdown has already begun. Once you understand the hidden mechanism that ends reserve currencies, you'll see why these $688 billion matter more than any Federal Reserve decision this year. A reserve currency rests on a single foundation: confidence. Countries hold your bonds because they trust that you can always repay them. But there's a built-in trap within the system. The more successful a currency becomes as a global reserve, the more debt its issuer must create to supply the world with liquidity. This mathematical contradiction has eventually undermined every empire that reached this position. By the end of 2025, the United States carries $38 trillion in debt. Servicing that obligation depends on foreign buyers, China, Japan, Saudi Arabia, continuing to purchase U.S. bonds. They must believe the dollar is safer than anything else available. But what happens when the rising power no longer believes? Britain faced this exact problem in 1931, burdened by enormous debts from World War I. The economic cost of the war had hollowed out Britain's finances, while public attention focused on victory celebrations and territorial gains. France, economically stronger after its recovery, decided to test Britain's credibility: prove you can pay, convert our pounds to gold. Britain couldn't comply. There wasn't enough gold in the vaults. On September 21, 1931, Britain suspended the gold standard. In practical terms, it was a default. Empires never admit default outright, but the pound sterling lost its credibility in a single day. Within 15 years, the US dollar replaced it as the world's reserve currency. The British Empire, the largest in human history, entered an irreversible decline. What took centuries to build unraveled in less than 20 years. Now look at 2025. China's treasury holdings have fallen from $1.3 trillion in 2013 to $688.7 billion today. That's a reduction of $628 billion, a 47% decline over 12 years. Yet this is the detail most financial coverage overlooks. China didn't reduce its holdings slowly like a typical investor adjusting a portfolio. According to U.S. Treasury data released on December 19th, covering October 2025, China has dropped to third place among foreign treasury holders, behind Japan and the United Kingdom. This marks the first time since 2017 that China is no longer among the top two. Think about what that implies. The world's second largest economy and America's biggest geopolitical rival has steadily dismantled its position as the second largest U.S. creditor. This isn't routine portfolio management. It's strategic repositioning. And here's the parallel that should alarm anyone paying attention. As China offloads treasuries at a faster pace, it's also stockpiling gold at a record rate that doesn't look like normal central bank behavior. Through September 2025, China bought gold for 11 consecutive months, bringing total reserves to 233 tons, according to official reports. Gold broke $4,000 per ounce in October 2025 for the first time in history. This is the 1931 playbook unfolding in real time. France sold pounds while buying gold, and China is selling treasuries while buying gold. The mechanism is the same: reduce exposure to the existing reserve currency while accumulating the crisis hedge that has preserved value for 5,000 years. But the question that should keep Treasury officials awake at night is, this why now? Why did China accelerate these sales in 2024 and 2025 after years of slower, more controlled reductions? The answer points to a debt trap tightening around the American financial system. And the math is darker than anything you'll hear from Jerome Powell or Janet Yellen. What I'm about to show you next isn't speculation or a conspiracy theory. It's documented data from the Congressional Budget Office, the Federal Reserve, and historical records. It shows this same pattern has ended every major reserve currency era in modern history. The British didn't see it coming in 1931. They believed they were too big to fail, too established to collapse, too central to the global financial system to be replaced, and they were wrong. The question isn't whether the United States faces the same test. The question is whether we'll recognize it before we reach our own September 21st moment. Let me take you back to what happened in 1931. The parallels are so exact it feels like China is following a script written 94 years ago. Summer 1931, the Bank of England held $150 million in gold reserves. To the British public and to much of the world, that sounded impressive, reassuring even. But French financial ministers had already done the math. Foreign creditors held £400 million in sterling deposits at British banks. The numbers didn't work. Simple division showed that if even half of those creditors demanded conversion into gold, Britain would be completely drained. It was a national-level bank run waiting to happen. France knew it. They had watched British finances weaken through the 1920s, while everyone else celebrated the Roaring Twenties. In July 1931, France began requesting gold conversions not all at once, to trigger instant panic, but strategically, methodically testing the system's breaking points. By September, the Bank of England had lost £200 million in gold in just 8 weeks. Picture the scene: ships carrying gold bars from London to Paris, a physical transfer of wealth from a declining empire to a rising power. On September 21st, they capitulated. The gold standard was suspended. The pound dropped 30% overnight against other currencies. Here's the detail historians often miss, but strategists understand. France didn't act randomly or out of spite. They moved because they saw Britain's debt trap with mathematical clarity after World War I debt crushed British finances beneath the victory propaganda. By 1931, debt service consumed 44% of government revenue. Nearly half of what Britain collected in taxes went to interest on old debts. Not infrastructure, not defense, not the future, just the past. Britain couldn't grow out of it as the world slid into depression. It couldn't inflate the burden away because the gold standard restricted money creation. And it couldn't pay honestly without wrecking the economy through crushing taxation. So when creditors demanded real payment in gold, it was over. Now fast forward to December 2025, and the numbers should make every American uneasy. The United States debt to GDP ratio is 122.6%. By the end of fiscal 2025, that's higher than Britain in 1931. Interest payments reached $970 billion. $970 billion just in interest. For the first time, that's more than defense spending, and projections for 2026 push interest costs above $1 trillion. Here's the trap tightening around the Fed, and the Treasury raise rates and debt service explodes. Every half-point increase adds roughly $100 billion to annual interest as debt rolls over. Cut rates too aggressively, and inflation risks erode purchasing power and credibility. The Fed is boxed in like the Bank of England, in 1931 trapped between impossible choices. Powell signaled confidence with talk of soft landings and controlled adjustments. But the bond market told a different story. Treasury yields stayed high. The 10-year sits at 4.14% in December 2025. Translation: the market doesn't fully believe the Fed. Traders demand higher yields for risk, just as creditors stopped believing Britain's reassurances in 1931. And China sees it clearly. That's why holdings fell to $688.7 billion, and why the selling accelerated in 2024 and 2025 after slower reductions. They're not rebalancing a portfolio. They're leaving a burning building. And there's more evidence this isn't normal reserve management. In 2025, the mBridge payment system, China's alternative channel to SWIFT, became fully operational according to the Bank for International Settlements. It allows international settlements without using dollars. Think about what that means. The plumbing for a post-dollar world is already in place and working. BRICS expanded in 2024, adding Saudi Arabia, the UAE, Egypt, Ethiopia, and Iran to the original Brazil, Russia, India, China, and South Africa core. That's 45% of the world's population now operating with less dollar dependence and exploring alternative settlement systems. And the gold buying tells the real story of what central banks are preparing for. Central banks globally purchased 1,037 tons of gold in 2023, the highest level since 1967, according to World Gold Council data. China added gold for 11 straight months through September 2025, bringing official reserves to 233 tons. Gold broke $4,000 per ounce in October 2025, a historic milestone signaling institutional money moving to safety. This is the 1931 pattern intensified by modern technology and coordination: sell the reserve currency, build parallel systems, and stockpile gold. France did it alone in 1931. China's doing it with half the world's population economically aligned. What should really grab our attention is the speed. China still held over $1 trillion in treasuries as recently as 2016. They've dumped nearly $400 billion in less than a decade, with the pace increasing each year. In 2013, holdings peaked at $1.317 trillion. By 2020, they fell below $1.1 trillion. By 2023, below $900 billion. And by October 2025, $688.7 billion. That isn't gradual rebalancing. It's systematic liquidation on a clear trajectory. So the question everyone should be asking, the one Treasury officials are asking in private, is simple. When does the selling hit the breaking point? When does it accelerate enough that Treasury auctions struggle yields spike and the system enters a terminal cascade? Because there is a mathematical threshold, a point where there aren't enough buyers to absorb U.S. issuance at stable yields. At that point, the choice becomes higher rates that explode debt service, or the Fed printing money to buy its own bonds, the Weimar Germany scenario that ends in hyperinflation. That threshold is closer than most people think, and the timeline is tighter than anything you'll hear on CNBC. Let me show you the math. Wall Street doesn't want highlighted the calculations that explain why some of the smartest investors are quietly shifting their portfolios right now. As of October 2025, China holds $688.7 billion in U.S. Treasuries. From the 2013 peak of $1.317 trillion, that's a reduction of $628 billion, a 47% decline over 12 years. But here's the critical level bond traders understand and rarely discuss publicly. Liquidity starts to break when a major holder drops below $500 billion. Below that point, there aren't enough stable, predictable buyers to absorb issuance without yields jumping sharply to attract marginal demand. At recent reduction rates of $50 to $60 billion per year, with clear acceleration in 2024 and 2025, China reaches $500 billion by late 2026 or early 2027. Now here's the reality that compresses the timeline. The United States must refinance $9.2 trillion in debt by December 2025, according to Congressional Budget Office projections. That's maturing debt that has to be rolled over, new bonds sold to pay off old ones. So who buys? Japan is the largest holder at $1.15 trillion, down from about $1.3 trillion. The United Kingdom is second at roughly $900 billion. China is third at $688.7 billion and falling. Those three make up a huge share of foreign treasury demand, and two are reducing exposure. CBO also projects interest payments will exceed $1 trillion in 2026. We're already at $970 billion in fiscal 2025. 5 years ago, it was under $400 billion. And here's the trap: every half-point rise in treasury yields adds about $100 billion a year in interest costs as the debt rolls over. The 10-year yield is about 4.14% in December 2025. If it reaches 5% plausible, if selling continues and demand weakens, that's roughly $200 billion more in annual debt service. That pushes interest costs from $970 billion to around $1.17 trillion. That's approaching 20% of federal revenue going to interest alone. That's the 1931 Britain problem where the math stops working. And these collapses don't unfold like slow erosion. They move in stages, then accelerate. Stage 1, the slow burn, 2013 to 2023. China falls from about $1.3 trillion to $800 billion, and markets shrug it off as routine. Stage 2, the acceleration 2024 to 2025, $800 billion, drops to $688.7 billion. China slips to third place and yields stay high even with Fed cuts. Stage 3 is the liquidity squeeze projected for 2026. Multiple major holders sell at once, and auctions clear only at higher yields. Then the Fed faces the nightmare choice: let yields spike and blow up debt service, or buy the debt with newly created money. Stage 4 is capitulation, projected late 2026 into 2027. The Fed announces temporary quantitative easing despite inflation risk. The dollar plunges against gold and other hard assets. Reserve currency status enters terminal decline. Alternative rails like Mbridge see rapid adoption. This becomes our September 21st, 1931 moment. Britain went from stage 2 to stage 4 in 8 weeks in the summer of 1931. 8 weeks from worrying to catastrophic. We entered stage 2 in 2024 to 2025, when China fell below $700 billion and the selling clearly accelerated. If the pace mirrors 1931, stage 4 could arrive between mid-2026 and early 2027. That's why these signals matter. They're the early warning indicators that show when we're moving from one stage to the next. Trigger 1. China drops below $600 billion projected for the second to third quarter of 2026 at the current pace. That marks liquidation beyond normal reserve management. When the third largest holder falls that low, it signals a deep loss of confidence in dollar stability. Trigger 2. Treasury auction failures projected for late 2026 auctions that clear only at unexpectedly high yields to attract buyers. Britain saw this in August 1931, when auctions suddenly demanded far higher yields than expected. Watch for sustained 10-year yields above 5%. Trigger 3. Fed emergency measures in the 2026 to 2027 window: temporary bond purchases despite inflation risk. This is the Weimar moment: printing money to buy your own debt because no one else will at reasonable rates. Trigger 4. Gold breaks $5,000 per ounce and holds. It's already above $4,000 as of October 2025. Goldman Sachs projects $4,900 by December 2026. When gold clears 5,000 for weeks, that's institutional money fleeing to safety en masse, not a speculative spike. Trigger 5 interest payments exceed $1.2 trillion projected for 2027 under current trends and modest yield increases. We're at $970 billion in fiscal 2025, with CBO projecting over $1 trillion in 2026. If yields jump and interest hits $1.2 trillion, that's 20% plus of federal revenue going to interest alone. Britain's threshold was 44%, but today's debt load relative to the economy is heavier. And here's what makes the timeline even more dangerous. Political transitions create peak vulnerability in any system. If a shock hits during election uncertainty or a presidential transition in 2026 to 2027, institutional response weakens. Agencies struggle to coordinate, policy becomes unclear, and foreign partners don't know who has authority to negotiate. That's the Britain scenario. Political chaos plus financial crisis equals systemic failure. Britain had a minority government in 1931, unstable leadership, and no capacity to respond fast enough when the crisis hit. So here's what you're watching unfold in real time, and this should change how you think about the next 2 years. China isn't reducing holdings to $688.7 billion in treasuries because it needs cash at home. China has $3.2 trillion in total reserves. They're not desperate for dollars. They're selling because they see what France saw in 1931 with mathematical certainty, a debt-trapped empire that can't grow out of its obligations as growth slows. It can't inflate the burden away without destroying credibility and triggering currency flight. And it can't service the debt honestly without crushing the economy through massive tax hikes or brutal spending cuts. The math doesn't work. China knows it. Russia knows it. They've effectively stepped away from treasuries in recent years. BRICS nations know it too, which is why they're building alternative systems. The only real question is timing. When does selling accelerate from $50 billion a year to $100 billion to $200 billion in a single quarter? Because that's when stage 3 becomes stage 4. That's when we move from concerning to catastrophic. That's when the cascade begins. Britain had 8 weeks from acceleration to collapse in 1931, 8 weeks from troubling signals to abandoning the gold standard, and we're in the acceleration phase. Now confirmed by October 2025 data showing holdings at $688.7 billion and a fall to third place. By this math, by this historical pattern, late 2026 through 2027 is when you'll know. That's when you'll find out whether the dollar holds as the world's reserve currency or whether we're watching the opening chapter of the end of American financial dominance. The same kind of move that broke Britain by 1931 is unfolding again. The same mechanism, the same stages, the same sense of inevitability. And just like 1931, most people won't recognize it until it's too late. They'll keep reading reassuring headlines about strong fundamentals right up until the day the system snaps. But you're not most people anymore. You watched this. You know the pattern. You understand the mechanism. You can see the stages forming. Now the question is, what do you do with this information? If this analysis helped you connect the dots between history and current events, hit that subscribe button. Because when these triggers start firing in 2026, you'll want real-time breakdowns, not mainstream spin that says everything is fine until it suddenly isn't. Drop a comment. Do you think China is deliberately pressuring the dollar, or is this simply reserve management? I want to hear whether you see coordinated strategy or coincidence. And if you want to see the exact assets I'm tracking, as this develops the specific hedges against dollar instability, check the description below. The empire is cracking, the math is breaking, the pattern is repeating. The question is whether you'll see it in time.